some of the presentation, and I'll chime in when needed. I think we're about ready to go.
All right, yes. So now that we hit the 2 o'clock mark, and we'll get started here. So yeah, as Ellen mentioned, we'll be talking state taxation of digital goods, software, and related services. Uh, so yeah, moving forward, yeah. So the presentation, obviously me and Ellen. I know there's some new faces out there, so if you haven't, talked to us or seen us, this is us. Ellen is one of our tax directors, and I'm one of our senior associates. So. All right, let's get started. So what we're gonna do today is kind of, this is I don't want to say a new area, but it definitely is a big area in state taxation, and it's continuing to grow. So we're gonna go through a lot of terms today. First and foremost, we're gonna define a lot of those terms, and then we'll kind of go into some tax trends across the United States. Look at some specific state treatments, and kind of show you the variety that the states can have between them, and then we'll kind of talk about sourcing, planning for these products. So here first, yeah, we're kind of going to talk about the computer-based electronically delivered products and services. We'll define a lot of them. So first and foremost, we kind of want to talk about the Streamlined sales and use tax agreement across a lot of states. So a lot of states adopt this. 25 states are members of this, and being a member of this SAUTA doesn't necessarily mean you're required to adopt a lot of the taxations or a lot of the definitions, but a lot of these states do treat certain taxations or sales taxes very similarly. So they have set forth a definition which defines a specific digital good by electronic transfer. And these goods are digital audio visual works, so consider like movies, things like that. Digital audio works, which will be like music, audiobooks, things of that nature, and then digital books themselves. So of these 25 states, 12 really adopt this definition. And again, a lot of these states, really the big area in a lot of digital goods or digital services and whatnot is, can you tax intangible property? But how a lot of these states treat that is they treat this as tangible personal property. And that's how a lot of the taxing schemes work for sales tax across these states.
Good point, Troy.
Yeah. So we'll keep bringing that point up as we kind of go, because that is the kind of like a big highlight of this area, because they are digital goods, right? They're not tangible. They're software as a services, things of that nature. So we'll keep making that point very clear. And then when we talk about transfer electronically, we'll probably bring this up a lot too. This just means that things are being downloaded, accessed via online, streamed, things of that nature. Think of Netflix, right? You don't have the actual DVD anymore. You go into the streaming services and pull your shows from there. So tangible storage would be like a disc, a CD, a hard copy, a USB drive, things that are more tangible. Really, we don't see that anymore. It's kind of been phased out. They also provide tax treatment for digital code, but that tax treatment is really under the same umbrella as specific digital products, specified digital products rather. So they do usually see the same taxation under that. Moving forward. So again, these specified digital products, these are really, in terms of products and goods, a lot of what you'll see. So again, digital books, just really, kind of what you see online, a lot of Kindles, things like that. You have your audio works. That this even goes back to ringtones. If people remember having, buying and sharing ringtones on their phones, that's what this falls under, as well as music. Digital audio and visual works. Again, this is whether it be a show, a movie, something where and a product was put together using those kind of visual needs. That's what that falls under as well. So that's just a broader definition of those. Now the MTC, which is the Multi-State Tax Commission Planning Committee, they're really pushing forward in this kind of area because it is expanding across a lot of different states. and they really want to identify potential best practices across all states to increase a lot of same sales tax, either definitions or practices or anything like that, and have some uniformity. So meaning that you'll kind of see that a lot of these states treat one thing one way and another thing another way, and it's just a different across the board. And the MTC is trying to, I wouldn't say combat that, but they see an opportunity and be like, hey, let's adopt a lot of the same definitions, a lot of that. So this is a little bit more of down the pipeline potentially, hopefully, that we can consider a lot of uniformity moving forward. But they believe it is necessary because the majority of the states with sales tax at least tax a lot of these digital products and services at some rate. Whether it be, software as a service or canned software, a lot of these states that do have sales tax do want to impose sales tax on most of these.
We'll get into that a little more later too,
Yep.
as far as which states tax what. So we'll be in that in just one second. But the MTC is, along with the Streamlined Sales and Use Tax Agreement states, their goal is to, like Troy said, try to get this into a more uniform mode so it's easier to understand and basically advise clients as well on.
Yeah, exactly. So we're going to kind of go through some products, or not some products, but some softwares, some services, and then some related things. We'll expand upon these as we're kind of going. We know this is very convoluted, so we just want to give some broad strokes. But software is really considered a good rather than a service, meaning that software, like how we think of it, is very intangible, right? But you can install it on your computer or what have you on some of your systems. But a canned software, and thinking of the word canned, and we'll expand upon this in the next slide, it's really a standardized software that is delivered to any type of customer that the provider would have. So it's not customized in any area. One software delivered to one customer is the exact same as a software delivered to the next customer. How I kind of think about this is like, remember back in the day when you used to have the AOL CDs and they would give them to you? It's kind of like that. It was the exact same program, just across the board to all the customers. Now, custom software, a little bit different, not taxed as much at all, because it is custom made for the user, for the purchaser, for a specific need or to get a specific job done or anything like that. So you'll see that being taxed a lot less in terms of custom software. So services, we have these acronyms here, which is software as a service, SaaS, platform as a service, PaaS, and then infrastructure as a service. And we'll define these a little moving forward. These, especially software as a service, is a big area of taxation, expanding across a lot of different states, kind of moving forward. They've started treating these as tangible goods, as previously mentioned. So, but software as a service is a large service that is expanded upon a lot of different states. So it is becoming a big sales tax opportunity for a lot of states. Information data processing, this is a little bit kind of older. We've seen this in the past. So that is a service. And then cloud computing kind of embodies the previous three that we talked about, but some states expand upon it in a different realm. And you can kind of see that in the variables between states, especially with definitions. Do they include it as software as a service, as cloud computing, or do they view cloud computing as completely different? And then your software related services, this is your maintenance, your warranties, your things like that, your canned softwares and whatnot. So those kind of get sometimes bundled in with a lot of these softwares, a lot of these services, but they can also be sometimes deemed taxable, especially in the maintenance and implementation road. So here we're just going to expand upon custom versus canned. Again, custom software is very tailored to the end user. It's modified a lot of times on the individual requirements of the purchaser, or custom made and modified to design a particular use by a purchaser. So if you were looking to get custom software, it would be tailored to, or let's say we're doing it as a firm, it would be tailored to PKF and its needs. It's not just to generally to accounting firms or anything like that. CAN software would be that generally, has a specific statements or uses or instructions that can be used kind of across the board. Implementation versus installation. We see some taxability here, especially with implementation. When it's bundled with taxable software, it also is typically taxable. Sometimes when it's separately stated, these costs are also taxable in several different states. And those states are kind of listed there for 2020. Now, software maintenance agreements. This is what we touched on the last slide a little bit. So sometimes like optional software or for separately stated maintenance, things like that, those are typically non-taxable. There are some exceptions, but when it's bundled or when the provider makes it mandatory, that's when you kind of fall in the realm where it's going to be taxable. And again, warranties typically non-taxable. So here we have cloud computing. Again, we've all heard of the cloud. I'm sure by now, I'm sure we all actually use the cloud, and maybe not day to day, but in a lot of our practices. So cloud computing is defined as the on-demand availability of a computer system resources, especially data storage and computing power without derived active management by the user, meaning that you can go into the cloud, access your information, access your stored data, and pull it whenever you want. It's usually an online internet-based storage area. So it's not like you're going to a specific hardware and pulling out your information. You're really reaching it from the quote unquote cloud. A lot of these services, now this is not a state definition. A lot of these services are, software as a service, infrastructure as a service, and platform as a service. These are considered cloud-based because, as we'll kind of see here shortly, for example, platform as a service, they really don't give you the title or possession of the actual software, but they allow you access to it and allow you to use it for your needs that you have. So again, we consider those clouds. Some states do, some states don't. It does tend to vary. So here's what we'll kind of break apart each as a service here. So first we have software as a service. Again, this is probably the biggest one of the three. And it is considered tangible property, even though it is a service. And sales tax typically does apply to these. But software as a service provides or offers the use of software on a per transaction basis through a service contract or by subscription. Software as a service providers usually do not transfer software to their customers. Rather, the software as a service providers allow customers to access software through remote means. Again, that's getting back to the cloud computing. They don't actually provide them the software. They have the software in the cloud, and then their users are allowed to kind of come up to it. And you'll kind of see that through all of these. So
it's worth noting that this can be customized too. This may not work exactly like our definition on the screen, but it's generally, as Troy said, an issue where you've got some kind of software being provided, and perhaps your contract is to upload certain data, such as payroll data, and then it's compiled by the software, and then also a report is generated. So there could be a number of different types. The report might be considered a digital good. The software as a service is taxable in many states now, customized or not. It's more of a case-to-case basis, and you have to look at the state statute. But this is a good general idea of what it does.
Yeah. Moving forward, platform as a service. So typically we have platform as a service they basically provide a network, services, storages, and other services to customers, allowing them to create softwares. This is considered tangible personal property again. Past providers retain and operate the software application to which they sell access to. So similar to kind of software as a service, they're selling access, they're not giving possession or rights or anything. Customers don't receive a title or take possession of the software. And past providers is not treated as a reseller of a license to use software either. So those are kind of in there. That's the breakout of them too. And then the third leg, the last one, is infrastructure as a service. IaaS providers purchase and maintain hardware, software, and any other equipment services to support and manage the content of data flow to its customers. Think of this a lot of like an IT function, or they would have servers or things of that nature. So if you were a smaller business or a smaller firm and you don't have, whether it be the capital to purchase a bunch of computer servers, you would actually reach out to a firm that has infrastructure as a service, and basically you would use their servers or anything like that. And again, a lot of that would be through the cloud. So maybe they would have a massive cloud server that you would use. Again, they maintain ownership. This is considered a tangible product. So there's no transfer of title or anything like that. So
this has become more popular too, in order to, so as he mentions, disaster recovery strategy, or to make sure that your networks are secure and you don't have data leaks. So this is a great way, if you can get a good price and a good provider, to make sure that you don't have those issues with disaster recovery or data leaks.
Yeah, precisely. So we kind of touched on these. I'm not going to spend too much time on these slides. Basically, and we're going to kind of look at a lot of these trends with actual kind of more data. But the gist is these are really subject on a state-by-state basis to their sales tax. So not all states tax it that have sales tax, but we'll kind of get into a lot of the trends, and you'll hopefully paint a visualization to kind of see where that taxation is kind of coming from. So here, again, we're going to look at a lot of trends. We're going to have a lot of hot maps of the United States to kind of hopefully broaden everyone's horizons. So first, we're going to look at, these are the SSUTA. So this is Streamlined Sales and Use Tax Agreement members, and how they tax digital services with products. Ellen touched on this. So sometimes a digital service will spit out a digital product, and 17 members of this agreement impose sales tax. So anyone in really orange, you can see that'd be taxable. Blue here is a state that is not a member of this. So that's why it's an NA. So really what you can see here is it isn't uniform across a lot of these members. There is some, most may be taxable, but some aren't. So while they do have a membership in this SSUTA, it doesn't necessarily mean that they have to impose tax or have to adopt a definition. Basically, this governing board really brings a lot of things up, and it's up to the state to dictate whether they would like to accept it or not.
But actually, they do have quite a few members, 17 out of 23 or 24, arguably, that do tax digital. Yep. And then there's 10 other states that are members that tax digital as well.
Sorry. Yeah. So yeah, 17 members that impose the tax, and then 10 other members that don't. Kind of like Ellen said. So moving forward,
the tax, they're just not members, is what?
Yeah.
The 10. Okay. Good.
And then here we have the members that impose sales as a service. So again, similarly, we see a lot of this happening in the Midwest, right? So that's where a lot of the taxation from these members are coming from. But yeah, again, a lot taxable. Most are taxable, but some again are not. Moving forward, we have cloud computing. For these members. And again, as you can see, it's slightly different, not a lot of difference between this, but we just want to show this distinction. While SaaS can be considered cloud computing, that is not always the case. Cloud computing can be, in certain states, considered a separate non-taxable activity or a separate taxable activity. So here, again, we'll touch on software as a service. This is the United States as a whole. This map may be a little bit outdated. but it does paint a really good picture as software as a service throughout the United States. One state we kind of do want to bring up and we kind of hit on all the time because we are talking software, we are talking technology, and that's California. That's the Silicon Valley hub. A lot of software, whatever have you, technology, internet-based companies are based out of there. So you are going to see not a lot of taxation out of there, whether that be a lobbying or whatever have you, because typically California loves to tax, but for some reason, not when it comes to digital goods or software as a service. So 35 states do tax SaaS, and that is an updated number for the upcoming year. Typically, the state will impose transaction sales tax on gross receipts derived from the sale of computer software programs and applications. So again, it's on the gross receipts. Okay, moving forward, got another map for you. So again, here's the CAN pre-written software. So this is a very common taxable software. Custom, not so common, but when CAN is compared to software as a service or some of the other services, this one is very popular to be taxed. As you can see, the the Midwest region and the Eastern region have the most states that love to tax this. Again, California does not tax this. But
actually, California does tax this, and that needs to be updated on our map. But California does not tax anything else. CAN software is it. Yeah.
Okay. Sorry, I misspoke there. California does tax this. Moving forward, so we have custom software. Obviously, if I can go back, drastically different than what we saw for the CAN software. So a lot of things go down for the custom software, but again, a lot of the southern kind of region, southern states do like to tax this. Only 14 states do impose sales tax on custom software. Most states that do tax this also tax CAN. I think, what was that? Iowa and South Carolina are the only exceptions to that. Okay. Moving forward. So here we're going to go through a lot of the state treatments on a state-by-state basis. So we wanted to cover, a lot of the common states that we kind of see at PKF Mueller, whether it be based off our clients or just in general. So here we have Alabama with a little table. So Alabama does really tax basically everything when it comes to a lot of these digital products or digital services. Their definition is when it comes to digital photographs, specifically Alabama regulations identify digital files as tangible property and thus taxable. Based off these regulations, that are broadly interpreted, Alabama's definition of tangible personal property includes the digital goods are considered taxable in that state. So and we'll see a lot of these definitions throughout a lot of these states, and we just kind of want to iterate that they will be different. And that's one of the things of this kind of realm of digital goods is how certain states define these goods.
And if you'll notice with Alabama, they're pretty much all in on everything. And states do tend to be either all in, they tax it all, or they're very particular about what they tax. So I've noticed that, and you'll see some of the trends as we go on, but a lot of the digital product states that tax digital products and services tax everything else too. That's a fairly common scenario. So this is an example of a state that's all in on this and has even enacted the Simplified Seller Use Tax Remittance Act to make it easier for sellers to remit use tax. So Alabama's definitely on board on this area.
Okay. California, we already talked a lot about this state. Obviously, they do tax CAN software. We're a little bit wrong on hot map, but here it's broken out where CAN software is their only really taxable digital service or good. Again, that might be derived because of who encompasses California and kind of what products they do kind of produce, since it is such a technical hub of the United States.
Yeah, both technical and, videos, movies, entertainment streaming as well. So they don't tax these areas.
Yeah, it's a very good point. A lot of entertainment. So Colorado just enacted HB 211312. This adds digital goods to the statutory definition of a tangible personal property subject to sales and use tax. This is intended to codify Colorado Department's long-standing treatment of digital goods and reflect it in its regulations. Again, the new law just treats digital goods as tangible personal property, regardless of how it's delivered. So if you get a CD or USB drive or whatever have you, even though it's not electronic, it's still taxable. And then
If you'll notice, the main definition in Colorado includes very traditional digital goods such as, video, music, electronic books, but generally a lot of the states do this. They say digital goods includes these, but they're not limited to these. So then we have to look into what else might be a digital good in the state. But this is a classic definition of the types of basic digital goods that a state will tax.
Okay, Illinois, we get to our home state. So as we could not for Ellen. I'm sorry, Ellen. We just touched your home state, but yeah.
I'm from Indiana, so yeah. So
yeah,
here's
again,
Illinois.
Here's Illinois. Again, canned software and then software as a service is really the only points that Illinois kind of touches on as taxability. We may see that kind of change in the future or something like that, but right now these are the only two digital products or digital services that they're really touching on.
So that's for the state, but as you know, Chicago has it's basically what they're calling here is an amusement tax on video, audio, gaming, and in this case, LaBelle, the Illinois appellate court upheld the lower court and said that the city of Chicago's imposition of this tax was legal and did not exceed home rule authority. It didn't violate the Constitution or the Internet Tax Freedom Act. So, and just to be aware, Apple has a current pending challenge. If you want more information on that, just reach out. And I'll try to provide more if there's a decision in that area. But Apple is challenging on constitutional grounds the fact that Chicago is overreaching and interfering with due process and interstate commerce by imposing this tax on non-residents. So we'll see how this turns out, but right now it's a viable tax.
Yep. It's the city of Chicago pushing through some taxes. What else is it? Indiana. So Indiana again has one of the most standard definitions that we kind of saw with the Streamlined sales and use tax agreement. So they really just define it as audio work, a book, or an audio visual work. And again, so Indiana likes to impose on any digital products, digital service with products, and then software as a service, and then canned software as well. No on the custom software, and no on the cloud computing. So that's kind of where they stand. So now we're going to look at Maryland. Guidance on digital goods, software as a service, and electronically delivered software. So Maryland, they issued guidance regarding the recent enacted legislation taxing certain digital products. They define digital products as a product that was obtained electronically by a buyer or delivered by means other than a tangible storage media using technology having electrical, digital, magnetic, wireless, optical, electromagnetic, or similar capabilities. And this is where they'll say a lot, including but not limited to downloaded or streamed audio, audio visual, books, photos, newspapers, magazines. Again, it's always the including but not limited to. Oh, they also explain that canned software delivered electronically as well as software as a service are also taxable. And then they also apply sales tax to online educational classes, live or pre-recorded, but not in person. So that is I think a new one or a different one that we've seen in terms of the education. So here's some of the examples. The revised version of its tax tip incorporates SB 787 amendments and provides numerous explanatory examples such as gift cards, electronic services, advertising agencies, again, education and entertainment, and data, documents, electronic communications, and again, software. So those are the kind of examples out there. And then Maryland's digital advertising tax. So it's the first state in the nation to impose a tax on digital advertising services. So that they have led the charge in imposing more taxes on digital advertising. So Massachusetts, New York, Texas, West Virginia are currently advancing legislation to also mimic what Maryland has passed. I guess there are two outstanding lawsuits, one federal, one state, are challenging the grounds on the raging of the constitutional rights. I think, Ellen, can you expand upon that before I kind of lose my lingo?
So the two lawsuits are, and I believe there are some other state level lawsuits, but these are the main lawsuits related to digital advertising. So one is federal, and the challenges there are based on the federal constitution, so that it's overreaching, that it's taxing non-residents, and that one of the interesting things about it is the rates are dependent on global digital advertising sales. So it brings in a global area that it's being challenged in particular for that reason, because it's not just a U.S. tax base. They're looking as well at global activity. As far as I can tell, they don't tax global activity, but they're determining a rate based on worldwide sales rather than just US sales. So that's one of the reasons it's being challenged at the federal level. The state level, some of the bigger companies, Comcast, Verizon, are also challenging on similar grounds, but also supremacy clause grounds and Declaration of Rights in the Maryland Constitution. So that's a state-based case, and I'm anxious to see how these pan out, and we'll keep you informed. One other point, if the tax is unconstitutional, they're expecting that other states, if it's declared unconstitutional in these cases and say the Supreme Court doesn't hear it, then other states may, have similar issues with similar laws. I don't think there's anything quite as global as this tax, but there are definitely some other state laws that are taxing digital, and it's hard to define what they're taxing, and it becomes an area of a lot of difficulty for vendors. So if it is found constitutional, we're also expecting more complaints similar to these cases here in other states, challenging that.
Okay, moving forward, we have Massachusetts. So Massachusetts defined a digital good as a digital product delivered electronically, including but not limited to music, video, reading materials, ringtones. Video would also be included in there as type of movies and things. So again, Massachusetts, they take a look at kind of a lot of software as a service being taxed, the canned software again, and then digital services with products. Again, that is a little gray area that they have. So something to look out for. Is it taxable? Is it not? For Massachusetts.
Generally, the digital products though now are taxable in Massachusetts, so that would be a yes on the first point.
So Massachusetts with remote access or cloud software. Ellen, do you want to talk about this case?
So this case just held that receipts from subscriptions to remote access software were subject to sales tax. So basically, those were transfers of pre-written software, and focus was on the fact that it was a pre-written software, and the focus was not on the service, which Massachusetts is more in limbo on taxation of. So basically, this just confirms that remote access software or cloud computing type transactions are taxable, and they're looking at the pre-written software as a tangible good.
So with Texas imposing sales tax, they are a yes across the board when it comes to products, digital services with products, software as a service, canned services, even custom software. Texas deems taxable here. So Texas defines the digital good as a tangible property. Digital products such as photograph, music, tangible personal property as defined in their code section 151. So Texas is one of those states where they say yes to it all for sales tax. So Wisconsin, they have a proposed guidance for sales and use tax of computer hardware, services, and software. Here for software as a services, charges for assessing pre-written computer software that'd be or canned located on a vendor's services is not taxable as long as the customers do not operate in the vendor's service, control its operation, or do not have physical access to the vendor's server. Again, that's something we kind of talked about when we looked at software as a service. Usually, it's the providers are giving access to the actual customers and not actually providing access or possession to them. And then infrastructure as a service, also deemed not taxable, is again as long as they don't have control or possession. And then platform as a service contains elements of both SaaS and IaaS. On the taxability depends on the favor, as mentioned above. So we have some state developments here. So we're kind of going to go across these. These are just things to look out for kind of moving forward, or if you're not aware of already, to kind of just take note of. So again, we kind of touched base on Maryland already. Their deemed taxable includes any digital downloads, electronic publications, sounds, video content, and subscriptions. Again, we did talk about the advertising as well. Iowa tax on software as a service, they don't even have a definition. So hopefully we get some development in that area. Rhode Island tax on vendor hosted written software. Pennsylvania, they added definitions to the tangible personal property to include any canned software, other tangible personal property that includes electronically delivered or digitally delivered. Those are all have now been deemed taxable. Washington, any access to research is treated as a digital automated taxable service. That is fairly new. That just happened in 2020. New York State, they have some information services, consulting versus taxable information services. So that looks like it went to what, the appellate court, Ellen, Court of Appeals.
Yeah, that was appealed. So personal use of public information, even if it's digital or electronic, is taxable, and it doesn't qualify for an exclusion. So basically, that public information use is taxable, but this is basically separates it from another type of information, such as private research, that kind of thing, that does qualify for the exclusion. So they just basically used personal use of public versus private information and decided one was taxable and one wasn't.
Oh, sorry, I kind of jumped right there. My mistake. Okay, moving forward. We have some other state developments. Access to kind of online educational services. Iowa's have deemed taxable. We kind of saw that with some other states previously. Although Wisconsin is taxing audio visual works, the commission has held that sales of digital CLE courses are not taxable. So again, those are those educational courses. Those are deemed not taxable because they're educational.
I would assume that goes the same thing for CPE. So there, anything educationally based isn't taxable.
Mm-hmm, mm-hmm. And the cloud services and digital media companies, EFAC services, were treated as taxable telecommunication services. So that's something also to be aware of. With Texas, taxpayer collected information from a restaurant customers and produced customer reports. They basically concluded that since they're pulling customer reports, creating a digital product per se, that is a taxable data processing and information service. So they have deemed that taxable, even though they're kind of just looking at some information. And then with Indiana, they're characterizing reports produced for informational services as a tangible personal property, kind of what we just talked about on Texas, producing reports, having a digital product, things like that, deemed as tangible personal property.
I think that's a really important area too to just be aware of, because you can imagine how many reports are generated by companies during operations, and be aware that there are a couple of states that are taxing those reports now.
Yeah, yeah. So New York, this is 2021, so this is just 2 months ago. They deemed, membership fees, so access to like web portals, the mobile app, and digital content is not taxable software. North Carolina subscription fees, charged to access the software platform were not taxable. They deemed it does not currently impose sales tax and use tax on revenue for access to cloud-based softwares, accessed electronically via the internet. So that'd be your software as a service for North Carolina. Rhode Island here. Again, this is at the tail end of 2020. Any pre-written software that enables the customer to use the software, access it in real time, advertising data. The taxpayer has argued that this constituted data processing and informational services, which has not been taxable, but the vendor hosted pre-written computer software is taxable, and the transactions were taxable, notwithstanding how the software was used. So any pre-written software is taxable for Rhode Island there. And then Ohio, they just touched on the provisions of online panels and surveys, responded for the market research, qualified as a electronic service under their REV regulations that they have there. So now we're touched on the latter end of the presentation. We're just going to touch a bit on sourcing and planning. So the SSUTA, again, that's the Streamlined Service Sales and Use Tax Agreement. They clarify that the sale of a digital good is sourced in the same manner as a tangible personal property or a service. So we really need to think, and I'm sure we're hitting you over the head like a drum here, but any type of digital good here, digital good or kind of digital service, for the most part, obviously it does vary state to state, as we kind of just went over, but for the most part, that these are treated as a similar product or service as a tangible personal property. So that's what we're just trying to detail. and that's how many states are adopting it. Many states are sourcing it like that. So it's really something good to consider, especially when you're seeing that either with a lot of your clients, or you're just kind of seeing it across the media, or you're looking at any type of kind of sales tax thing. It's good to understand that this area is going to grow and develop, and kind of move forward as we kind of continue to push into the digital age, and that all of this is most likely going to be subject, a lot of it based on the state, subject to sales tax, just because they are considered tangible personal property.
Yeah, I think we should keep in mind, and on that sourcing information back there, I think we should keep in mind that digital, too broad of a definition of digital goods is being challenged, especially in Maryland, with the advertising cases. And so there is some pushback on it, but I do think it's the new age, and tangible personal property is no longer what you might have thought of it previously. And on the sourcing, a lot of the states, I've seen this definition used often verbatim by states to source the product sales to a state. And Illinois has a similar provision in their taxes. So basically, they're looking for business location of the seller in purchaser state. And if so, that's going to be sourced to the purchaser, this business location of the seller in that state. Or the second way of sourcing is if the purchaser doesn't get it at a business location of the seller, if it's maybe mailed directly to them, then the location where they receive it and where basically title transfers is the end location for sourcing. And then there's some additional rules that sort of make decisions given other issues. So if the address for the purchaser is available from the seller's business records, that address can be used. And then if there's a sale agreement and there's an address used by the purchaser, that address can be used as another alternative. And then finally, basically, if there's no, and there are a lot of transactions now that are digital or electronic that they aren't showing who's purchasing, who's selling, they're guarding the information. And so there's some Bitcoin type transactions and selling of coding and different areas. So in those areas, basically, at least for Illinois and Wisconsin, we look to location being determined by the address from which the digital good originated. So, and for instance, if this is a foreign seller, then the digital good would be sourced to the foreign location. So if there are not all these other indicators because of the type of transaction. So hopefully that helps a bit with the sourcing issues.
Yeah, again, kind of to reiterate that, something with Texas here, if a service is supported on a separate identifiable segment of a customer's business, it's presumed to be used at the location where the business is conducted. So a lot of these states have actual sourcing agreements, and sourcing guidance, for each kind of transaction, even on the digital level. So again, if that part of the business is conducted at a location or at locations both within and with outside the state, service is not taxable to the extent used outside the state. So that's outside of Texas, rather. To the extent use of the service cannot be assigned to an identifiable segment of the customer's business, service is presumed taxable at the customer's principal place of business. So basically their primary place of business. That is sourcing. Ellen, do you want to talk about the multiple points of use?
So this is just another area of sourcing that's a difficult area. Initially, the Streamlined Sales and Use Tax Agreement provided for this MPU sourcing, but then the provision was repealed, so it's not in existence anymore, but it still lingers in certain states. And the idea was it prevented a business purchaser using goods in multiple jurisdictions to basically self-assess the use tax and pay it in. And so the purchasers were doing the apportionment and responsible for paying the use tax. Um, some states still continue to have similar provisions. Um, Otherwise, if the seller doesn't collect the tax, they're liable. So these provisions are good to look out for and use if possible. Washington does have a provision that's fairly similar to the MPU sourcing provision that was originally drafted. And another case, Oracle in Massachusetts, um, it also allowed similar apportionment to the taxpayer. So this was a situation where the seller was allowed to apportion to multiple states. Um, and because they had not, they didn't submit, the purchasers didn't submit a multiple points of use certificate, which is a particular form that can be submitted in Massachusetts. That the issue was, could the taxpayer, the seller, still source in accordance with those multiple points of use? And the Supreme Judicial Court in Massachusetts said they could. So, so basically, if they'd overpaid in Massachusetts and underpaid in other states, they could use the Massachusetts process to get refunds, the Massachusetts abatement process, and that was a viable method for determining if they had refunds due and pursuing the refunds. So I think that's a real positive case in that it's looking at really which are you sourcing to the correct areas when there are multiple points of use and a state saying we're going to let you make sure that you're sourcing correctly to those locations of use and we'll give you refunds if you overpaid in our state. So really positive case for Massachusetts.
Exactly. So now we'll touch on our final slide here. Just as some planning considerations. So we just want you to be aware, of a lot of things that we covered, and we're actually going to kind of show you a actual index or a chart that Ellen and myself have put together that kind of covers a lot of what we've already touched base on. So you don't have to go back to the PowerPoint or whatever and whatnot and kind of regurgitate all this information. Rather, you can kind of sort through an easy to use Excel file that'll kind of shed some light on a lot of your clients. But yeah, again, just consider what your clients are kind of being involved with, any kind of contracts, invoicing, or any kind of tax or subject to throughout these states. Make them aware that these digital services and digital products are being taxed, and a lot of states are looking at them. So it is a very hot topic for a lot of states to be considering changing laws. Look at Maryland. They're kind of approaching taxing advertising, but there's a lot of pushback from the industry and things and whatnot. So there will be some changes kind of moving forward, and we'll have future updates on that. And then there are secure exemptions or allowances to reduce the sales tax exposure and liabilities. So that is something to consider. But again, thanks for everyone to join. But before I let you go, I just wanted to show the the actual chart that we put together. So this is available in our SALT
In the
casework
SALT
folder.
research, right?
Yeah,
In
SALT research
case,
casework folder. Yep. So
and
again,
you have a copy too that, you know, a copy's been distributed along with the presentation. But I find this chart pretty helpful. I continually update it. But I find it pretty helpful just if you have a particular state that you want to take a quick look at. Um, we've gotten everything as accurately as possible for all 50 states, and then we've looked at different types of products, digital products, service with products, software as a service. The license is another issue. Is that taxable or not? If there's a license that's sold for a period, such as an annual period, along with the SaaS. There's canned software, which we've discussed a lot, and most states are on board there. Custom software, again, that's fewer states. And then cloud computing may be very similar to SaaS or could be more of a cloud storage base. So that is specifically defined in a number of states, and you know it's worth taking a look at whether they tax that or not. Not every, you can also see here and sort and look at the members of the Streamlined Sales and Use Tax Agreement, which tend to be a bit more aggressive on these areas. And then we have some authority and state websites at the end of this as well. So actually, I think it's a very good starting point, and then a little more detail, you know, would be needed to determine any particular scenario. But we wanted you to be aware of what's out there. The Wayfair thresholds are over here. But again, even if they sell over the Wayfair threshold, if it's not taxable, it's not. So if it's exempt, it's exempt. So that's important to remember in terms of they can meet the Wayfair threshold, but there's not automatic taxability, of course. And I think that's about everything. Certain states require notice and reporting, so that's for bigger sellers. They do have to report their sales in state, their specific requirements. That tends to be much larger sellers like the Amazons, and there are specific requirements in the millions that they have to meet before they are required to do the notice and reporting, which is in column H. But that's worth noting as well if they're a bigger vendor. So I think this gives you a little rundown on where do you tax, how do you tax, what do you tax in the digital goods and electronic area, and then feel free to use this chart. We'll continue to update it.
Yeah, absolutely. All right. Well, that kind of wraps it, everything up for me and Ellen. We have a few minutes left, so if anyone has any questions or anything like that, feel free to say anything that hopefully we can shed some light on.
No questions? Hopefully we haven't overwhelmed you. Well, be sure to get in touch if you do have questions. Happy to answer those.
Yeah, again, yeah, please reach out to the SALT email that's always out there. And then again, this chart that we kind of showed is in the SALT research caseware. So it is available to everyone. I know it was distributed by Laura earlier today, but it will be updated continuously, and we'll be kind of working towards that. So it'll be out there. Okay. Well, if no one has any questions, everyone have a great rest of your day. And thanks for joining our presentation. We hope you at least took something out of it, you know, at least expand upon your knowledge of digital goods and digital services.
Thank you. Good job, Troy, too.
You too, Ellen. You did great.
Oh, thank you. Okay. Thanks, everyone. Please be in
Bye,
touch
everyone.
if you have questions.
Thanks, Ellen and Troy.